Hey everyone, welcome back. In today's video, we're diving deep into AMC and everything that's going on with the market, from historical price movements to institutional accumulation, retail buying, and Adam Aron's recent announcements. First off, let's take a step back and look at AMC's recent price action. Despite what some might think, AMC is far from invincible, and its current near all-time low isn't unique. In fact, it mirrors patterns we've seen before, in April and May of last year, right before that historic 300% single-day surge. When you examine the historical data, one thing becomes clear. At these price levels, both retail investors and institutions start accumulating shares in anticipation of a breakout. This isn't a random trend. It's rooted in market behavior observed over multiple cycles. Investors have learned that dips like this often precede massive volume spikes, so naturally, people begin positioning themselves to benefit when the momentum shifts. What's particularly interesting this time around is the difference in who is accumulating AMC. Last year, accumulation primarily came from retail investors, the so-called apes, along with a smaller portion of institutions that had a long-term interest in AMC. This year, however, we're seeing a new trend. Some institutions that were previously aggressive short sellers have not only exited their short positions, but have actually flipped long and started buying shares. Goldman Sachs, for instance, has gotten rid of its short positions, closed out put options, and started acquiring long positions in call options for AMC. While this doesn't mean they've fully covered synthetic shares, which are hidden from filings, it is a strong indicator that previous skeptics in shorts are now participating in accumulation, significantly changing the market dynamics. The combination of retail buying, new institutional interest, and short sellers flipping long positions creates an environment that could easily result in a larger and more sustained breakout than we saw last year. Considering that additional synthetic shares have been created over the past year, once liquidity tightens, this accumulation could lead to unprecedented volume spikes that surpass the 300% single-day jump we saw previously. Next, we have Adam Aron's announcement, which adds another layer to the story. AMC revealed that it will be distributing a highly anticipated Taylor Swift event across the United States and in roughly 50 countries worldwide on October 3rd, 4th, and 5th. Taylor Swift's official release of Suspend will reach about 110 countries by the end of October. This announcement is particularly significant because AMC is directly distributing the event, unlike previous releases where other studios were initially involved. By handling distribution themselves, AMC not only secures a larger share of box office revenue, but also demonstrates operational competence that can attract other high-profile events in the future. The implications here are huge. More events mean more revenue streams and stronger fundamentals, which in turn make AMC a more attractive investment for both retail and institutional investors. This strategic move is part of a broader plan to solidify AMC's position in the entertainment industry, while simultaneously increasing its market value, giving investors confidence in the company's long-term prospects. Retail investors, or apes, continue to play a massive role in AMC's story. Platforms like StillUp provide examples of individual investors consistently buying shares, contributing to a steady inflow of capital. Even if a small percentage of investors sells shares, the inflow continues to outweigh the outflow, showing sustained confidence in AMC's growth potential. While price suppression tactics by market makers may obscure these trends on the charts, the reality is that both retail and institutional accumulation is happening consistently behind the scenes. Data from dark pools further reinforces this point, with 68% of AMC trading now occurring off-exchange. Dark pools allow large market participants to trade without immediate public visibility, which can suppress price movements on public exchanges. As a result, the accumulation we're seeing doesn't always translate to noticeable upward movement on standard charts, but it's happening nonetheless. Market makers and institutions have several reasons to suppress AMC's price, particularly during pre-market or aftermarket hours. Large buy-side volume can pose a challenge if they don't have enough shares to confidently hedge positions. By pushing the stock downward during low liquidity periods, institutions can acquire shares at cheaper prices, trigger stop losses, and optimize option hedging strategies. This manipulation benefits them in two ways. It allows accumulation at reduced prices, and it pressures retail investors who might otherwise sell at a loss. Meanwhile, short sellers aim to buy shares cheaply to cover their positions and hedge existing shorts, though they can only cover the real float, not the rehypothecated synthetic shares that are multiples of the actual float. This dynamic creates a tug-of-war between retail buyers, institutional accumulation, and shorts trying to minimize losses, adding complexity to AMC's price movements. In summary, AMC is currently in a unique position where historical patterns, retail buying, institutional interest, and strategic corporate actions all converge. Retail investors continue to accumulate shares, institutions are increasing their positions, and short sellers are navigating a difficult environment where liquidity is tightening and synthetic positions remain uncovered. Add in Adam Aron's bold move to directly distribute a highly profile event like Taylor Swift's release, and you have multiple factors aligning to create potential for a massive breakout. Understanding these dynamics is crucial for anyone following AMC because the price movements we see on charts are just the surface. Behind the scenes, the real story is accumulation, strategic positioning, and operational strength, all of which set the stage for what could be one of the most significant market movements we've seen in years.
Continuing from the momentum we covered in Part 1, let's dive deeper into AMC, the current market environment, and why the financial landscape is shaping up for potential volatility that could benefit investors who understand what's happening behind the scenes. One of the most important aspects to consider is the relationship between short sellers, liquidity, and market manipulation. As we've already seen, AMC has significant retail accumulation alongside institutional participation. But beyond accumulation, the real pressure on the market comes from the liquidity crunch affecting institutions and hedge funds that rely heavily on market conditions to maintain their positions. When liquidity tightens, short sellers find themselves in a precarious position because they can no longer easily finance their shorts or manipulate the market to their advantage. This is particularly true when synthetic shares, those rehypothecated multiples of the actual float, are in play. Shorts can attempt to cover the real shares, but the overwhelming synthetic exposure remains a ticking bomb. Reverse repo agreements, or reverse repos, provide another lens into this situation. Currently, the reverse repo stands at $25 billion, up from $13 billion previously, which signals an increased demand for quick liquidity among short sellers. While $25 billion might seem like a large injection at first glance, it's tiny compared to the trillions of dollars that have been available to these institutions historically. This is not a lifeline that saves them from structural issues. Instead, it's a temporary measure, a way for banks to make financial statements look stable while underlying problems persist. The long-term trend in reverse repos is actually downward, indicating that liquidity is steadily being drained over time. For short sellers, this means pressure is mounting, and any sudden market disruption could trigger panic buying, margin calls, and forced liquidations. It's a textbook setup for the kind of volume spike and volatility we've been anticipating in AMC. Adding to this, macroeconomic indicators suggest broader market instability, which could further tighten liquidity for institutions while leaving stocks like AMC relatively insulated. Consider the U.S. heavy truck sales, which have dropped to their lowest levels since the 2020 crisis, signaling potential slowdown in economic activity. At the same time, valuation metrics like the Buffett indicator show that the stock market is overvalued at more than twice the size of the U.S. economy. This is higher than the peak during the dot-com bubble, suggesting that the broader market could be on the brink of a correction. While other sectors might suffer from recessionary pressures, AMC's business model and its recent strategic moves position it as a relatively resilient stock. This mismatch creates a scenario where short sellers are exposed. As their other investments fall, they will be forced to cover or sell, while AMC remains steady or even grows, intensifying the squeeze on shorts. Institutional behavior in this environment is particularly interesting. Firms that previously shorted AMC now have a strong incentive to buy as cheaply as possible, both to hedge their positions and to acquire shares for future strategic purposes. Market makers exploit this situation through price suppression tactics during pre-market and after-market hours when liquidity is low. By pushing the price downward, they trigger stop losses, reduce the cost of accumulation, and manipulate option